Good morning, everybody. Hope you are wherever you are. My name is Gavin Kabel. I hope that you're fantastic, you're great, you are awesome wherever you are. Now, today, Siaivala, we are closing off the episode of the Khumalo story, The Broken Legacy. Now, I had split the episode into two parts. The first part, I introduced the family, spoke about Ubabu Khumalo, hailed from KZN, coming to Johannesburg, the city of gold, the city of light, getting himself a job. Then you're meeting Umamu Khumalo, falling in love, getting married. They have two beautiful kids, and then Ubabu Khumalo supplements his income by starting a fruit and veg business that becomes successful. He then buys himself the first taxi, and then he resigns at work, then buys himself the second taxi. Fast forward, they have a fleet of taxis. They are super rich. They live in a deep reef extension. So where to? Then Babu Khumalo diversifies his business interest. He then buys a filling station to complement his taxi businesses, his taxi business. And then from there, Babu Khumalo subsequently, years down the line, gets shot dead. He passes on, leaving everything to his family. And then 2 years after his passing, the family finds themselves with absolutely nothing. No taxis, no filling station, no house. Everything is gone. Now the question was, what went wrong? Now this story is not unique. This story, I'm sure you've heard about this story a million times. You probably have experienced it yourself personally. So, it has become normal. We have normalized it into zamuntu diamlatela. Izinto zomuntu ziyamlandela. A person's assets follows them to the grave when they passed on. We have normalized it. It's now part of our lives. But for me, it's a problem. For me, it has to come to an end. Because think about the ecosystem around the Khumalos. It's not only them who suffered in this whole ordeal or suffering in this whole ordeal, but think about their helpers, think about the taxi drivers, think about the cashiers at the filling station. All of those people's lives are affected, and their families are affected too. In this whole episode. So we need to be able to put a stop to this whole notion of Dintotsa Motu Damlatel. It has to stop. But what went wrong? If we have to dissect or diagnose, the story around the Khumalos. Now, for me, today I'm gonna concentrate on generational wealth, and I'm gonna split, my analysis into two. The first part is succession planning. The other part is asset structuring. Now, for the benefit of those who don't know what generational wealth is, for me, generational wealth is, the acquisition of strategic assets that are passed down from one generation to the next. So basically it has to do with assets. It has to do now with transfer of these assets from one generation to the next. Now, let's now go to the first analysis, succession planning. Why is succession planning very important when we talk about generational wealth? Now, for me, it's very simple. You cannot build an empire. You cannot acquire assets. You cannot, create anything that you want to then pass it on to somebody else without empowering that person that you want to pass on these things to. You have to empower them. You have to show them how it's done. You have to give them the knowledge. You have to give them the resources, so that they can be able to take over from you, but not only maintain whatever that you are leaving behind, but be able to grow, whatever that you're leaving, to them. So, you have to be able to empower them, because Ubabu Khumalo was very traditional. He came from a family that believed that the role of a woman was in the kitchen, and the kids, their role was just to go to school and get educated and finding good jobs. But he still wanted to leave all of this this empire to them, but he never empowered them. So please make sure it's not even a money thing. Those life covers, those properties, that provident fund that you're going to leave behind, empower your children, empower your family in terms of how they need to handle it, but most important, how they're able to grow from whatever that you have left for them. So it is critical. And please also concentrate on life skills. One of the things that you can also give your kids especially is to help them around survival. If I had to put my kids somewhere they've never been before, they must be able to survive. And that is why you see our brothers and sisters coming from the neighboring countries. They come here with nothing, but they're able to survive, and they're able to make success of their lives because they've been taught on how to survive in this world. So it is extremely important. Now let's go to asset structuring. Now when we talk asset structuring, there are three entities in which you can buy assets. So please get a pen and paper if you haven't already, right? So there are three entities in which you can buy your assets, especially the ones that will produce income. You can buy them under your personal capacity, you can buy them under a company, or you can buy them under a trust. So let's start with personal capacity. Now, when you buy them under your personal capacity, there are three challenges that you're going to face there. Number one is tax, number two is the risk, number three is the personal estate. So let's start with the tax. Now, you currently get taxed on your salary or your income from your business, right? So now, if now you buy an asset and that asset produces income, that income is now added on to your salary, meaning that it then pushes up your tax bracket, which means that it now pushes the amount of tax that you are paying over to SARS, to fixed Excom, and SAA. Story for another day. All right, so that is the problem. The more additional income you add to your current income, the more tax you're going to pay, right? So that is number one. Number two, we come to risk. So let us say me and you have an agreement, right? A legal agreement, and that entails maybe money or whatever exchange that may be, and I fail to honor that agreement. Now you can go to court and you can be able to be granted, they can grant you, leave to be able to acquire or to attach whatever assets that I have. So if I have those assets, they can then be able to attach them, sell them, and be able to recoup their money. So that is the second problem. The third problem is when it comes to the personal estate. Now, when we pass on, firstly, they need to then, establish whether we have more assets than liabilities. Because if now you have more liabilities than assets, then your estate is not liquid. That is the biggest problem that you can ever have, for your family, especially for your children. So now, in that regard, that is why it is important to use the services of people or professionals like financial planners, estate planners, and all of those guys to be able to help you to liquefy your estate. And one of the things obviously that help you to liquefy the estate is things like your life covers, so that can be able to bring balance within your estate, But it also talks around the costs that are involved with unwinding the estate. So we're talking about executors fees, we're talking about estate duty, we're talking about possible capital gains tax. So all of these amounts are costs that go out before your children, your nunu berries, your family gets anything. So it is important to understand that what is the cost of unwinding the estate. When I passed on, what will be the cost and how will it affect my family? So you need to be able to understand that, which is extremely important. All right, so those are the three challenges: the tax, the risk, and the personal estate. Now, when you buy under a company, so firstly, from a tax point of view, you buy you pay 28% company tax, which obviously it becomes much more beneficial to you. And remember, with regards to the company, there's a lot of flexibility around expenses. So you can deduct a lot of expenses, which will mean that your income reduces, which will also mean that your tax reduces at the same time as well, right? So now, compared to buying under your personal capacity, where your tax can go up to 45%, now with company it stays at 28%, plus the benefit of deducting a lot of expenses. So that is number one when it comes to tax. Number two, when it comes to risk. Now, going back to the example that I made where me and you get into an agreement, now you can come and attach a property that I bought under a company because it does not belong to me, it belongs to the company. So it becomes difficult for you to be able to attach that. So from an asset point of view, you sort of save when you then buy things under the company. But when it comes to the personal estate, because I'm the director and I'm the shareholder of that company, my shareholding still forms part of my personal estate, which then becomes a problem. So I cannot run away from the costs that are involved with unwinding the estate, and I cannot run away from the balance as well between the assets and the liabilities, because obviously if my liabilities are more than my assets, that is where then they sell the assets to be able to counter the people that I owe. Now let's come to the trust now. So when you buy under the trust, Now, the tax under the trust is 45% from the first rand of profit that you make, right? So from a flexibility, from a tax point of view, it might seem that it is just like your personal capacity, but there is a way that you can counter the tax through a system that is called the conrent principle, where you can use your children to conrent the tax, because of that tax bracket is low and you can be able to do that. But now the problem with that is that the kids grow up, and then when they turn 18, now they can be able to actually take over their assets. They can come and say, look, daddy, I'm taking over, this is my house, this is my property, this is my equipment, I'm taking it over. They can do that. So that is the problem that you will then face. But from a risk point of view, remember that the ownership of that asset does not belong to me, it belongs to the trust. Then it's safe. And then from a personal estate as well, whatever that lies in the trust doesn't get calculated as part of my estate, which then becomes safe from the costs that are involved with unwinding the estate. The other thing then is where you can use a combination of a company and the trust, where the trust then becomes 100% shareholder in the company, and then you buy those assets using the company. So you then benefit from the 28% tax bracket. You will benefit from the fact that the ownership lies in the trust, and you'll also benefit from the fact that, from a personal estate point of view, it won't be calculated as part of your personal estate. So all of these things, they're very important to understand how to structure, how to buy your assets, so that at the end of the day, you can then be, shielded against tax, you can be shielded against risk, you can also be shielded against personal estate. Now, that is why it's extremely important to use the services of your financial advisors, your trust attorneys, your estate planners, so that they can be able to help you in that regard, because your legacy, it's dependent on how you are structuring all of these assets that you are purchasing currently. So, when I finalize, when I conclude, succession planning is very important. Empower the people that you want to leave all of these things to, and asset structuring, very important to note the tax, the risk, and the personal estate, and how you can be able to mitigate the risk against all of these things, as you build on your legacy. Now, this is the conclusion of the story of the Khumalos and the broken legacy, and I hope that you have learned something. I hope that you can be able to show this video, to your friends, your families, so that end of the day we can really stop this notion of it's not bewitchment. No. It's just the way we do things. So I hope that you will take advice from everything that I've said, and you're able to make better choices. Now, in that regard, may you have an amazing and super awesome day. And it's Gavin Mkabela. Oh, please don't forget to subscribe. Click on that red button below. Tell your family, your friends to also subscribe as well. Now, it's Gavin Mkabela. I see you. I will see you. I'll see you. I see you on the flip side.